It's Monday morning, February 16th, 2026. You open your laptop, maybe with a cup of coffee, and you check the silver price on Bloomberg. $76 per ounce. Down hard. A clean, brutal drop. Financial media calls it a correction. Algorithms did their thing. Profit-taking. Volatility. Nothing to see here. But then you open the website of any major precious metals dealer in the United States and search for a 1-ounce American silver eagle. And suddenly the story changes. Because that same ounce of silver isn't selling for $76. It's listed at $85, $87, $90 if you want faster delivery. That's not a $2 or $3 premium. That's $9 to $14 over spot. That's roughly an 18% gap between what the official market says silver is worth and what it actually costs to buy it. And if you've been in markets long enough, you know that when two prices for the same asset diverge that widely, something underneath the surface has cracked. Before we go deeper, let me say this quickly. A lot of time and research goes into breaking down events like this in a way that actually makes sense, not just headlines and hype. If you value that kind of analysis, take a second to subscribe. It helps more than you think, and when the next dislocation hits, and it will, you'll want this in your feed, not buried somewhere under noise. Now let's get back to what happened, because this isn't just about silver. This is about how modern markets really function. On Thursday, February 13th, at exactly 8:47 a.m. Eastern Time, 17,000 silver futures contracts were dumped onto the COMEX in a single coordinated wave. Each silver futures contract represents 5,000 troy ounces. Multiply that out. 17,000 contracts times 5,000 ounces equals 85 million ounces. 85 million ounces of silver changed hands in 4 minutes. To visualize that, 85 million ounces weighs roughly 2,600 metric tons. That's more than 100 fully loaded tractor trailers. That's a warehouse the size of 2 football fields stacked 8 feet high. And yet none of it physically moved. No vault doors opened. No trucks rolled. It was all electronic. Promises traded on a screen. The price reacted exactly the way you'd expect when that much paper supply suddenly hits the market. Silver dropped from about $82.15 to $78 in 4 minutes. Circuit breakers triggered. Trading paused. It resumed. By Friday's close, the price settled near $76. A $6 decline in roughly 36 hours. If you were long those 17,000 contracts, that $6 drop meant a paper loss of about $510 million. $500 million erased in less than 2 days. But here's the detail that seasoned traders immediately focused on. Open interest didn't collapse. If those contracts were panic sold and closed out, open interest should have fallen by 17,000 contracts. It didn't. It dropped by only about 3,000. That means roughly 14,000 contracts, 70 million ounces, were not liquidated. They were transferred. Someone absorbed them. Someone with the capital to take on a position that had just experienced a $500 million swing. So ask yourself a simple question. Who has the balance sheet to catch 70 million ounces worth of falling silver contracts during a crash? It's not your average hedge fund. It's not retail traders. It's not small family offices. The list narrows quickly to a handful of global institutions, major banks and authorized participants who act as market makers. And here's where market structure matters. Market makers are supposed to provide liquidity. They stand between buyers and sellers, earning spreads. But when the same institution both makes markets and trades for its own proprietary account, you get a structural conflict. They see order flow. They see size. They see pressure building. And they can position accordingly. This isn't a conspiracy theory. It's how modern derivatives markets are designed. And when you see a massive dump followed by a transfer rather than a liquidation, you have to consider the possibility that the crash was less about fundamentals and more about mechanics. Because here's the paradox. While the paper market screamed $76, the physical market refused to cooperate. Dealers across the United States showed American Silver Eagles at $85 to $90. That's a $9 to $14 premium over spot. Historically, premiums on Silver Eagles have ranged from $2 to $4 over spot, roughly 5%. An 18% premium is not routine markup. It's stress. In functional markets, arbitrage closes gaps quickly. If the wholesale price of wheat falls, the retail price of bread eventually follows. If crude oil drops, gasoline adjusts. Traders exploit price differences until equilibrium returns. But in mid-February 2026, no dealer anywhere was offering physical silver at or near $76. If they could source metal at that price, competition would force them to sell closer to it. The fact that nobody did tells you something critical. The spot price reflected a paper market of futures contracts settled in cash. The dealer price reflected the cost of actual metal, sourced, stored, insured, and delivered. This divergence isn't new. We've seen this movie before. September 1980. April 2011. March 2020. 3 different decades, 3 different catalysts, 1 recurring pattern. In 1980, silver hit $50 per ounce during the Hunt brothers accumulation. Then rule changes at the exchange tightened margin requirements and restricted buying. The futures price collapsed from $50 to around $11 within weeks. But physical premiums stayed elevated. Dealers were not selling at $11 plus a small markup. They were pricing metal based on scarcity and replacement cost, not on a futures screen distorted by regulatory intervention. Fast forward to April 2011. Silver touched $49.50. Then 18,000 contracts, 90 million ounces, were dumped in about an hour. The price fell to the low 30s by the close. Yet for months afterward, physical premiums remained between $8 and $12 over spot. If futures said $32, buyers were often paying $40 or more for actual coins. Dealers weren't confused. They were responding to real supply constraints at refineries and mints. Then March 2020. During the COVID-19 panic, silver futures crashed from $18 to $12 in 72 hours. A 33% drop. But try buying physical silver at $12. Dealer websites went dark. Products were marked out of stock. Premiums exploded to $9 or more. Delivery times stretched to 6 weeks. The paper market said 12. The physical market effectively said 21. Again, 2 prices. 1 metal. So when February 2026 delivered another episode, a rapid futures crash combined with exploding physical premiums, experienced participants didn't see randomness. They saw a pattern. Derivatives markets have grown vastly larger than the underlying physical supply. Paper silver trades in volumes that dwarf annual mine production. When most contracts settle in cash rather than delivery, price discovery migrates from physical transactions to algorithm-driven order flow. Now think about the implications beyond silver speculation. Companies hedge commodity exposure using futures. A manufacturer expecting to sell silver might lock in $76 via futures. If their contracts settle in cash at $76 while physical buyers are paying $85 to $90, their hedge produces an unexpected windfall. Conversely, an industrial user who hedges by buying futures at $76 might receive cash settlement at that price but still have to pay $85 or more to secure actual metal for production. The hedge fails to reflect procurement reality. The assumption that futures and physical prices track closely breaks down. For smaller businesses, the consequences are even more direct. If you budget based on spot price plus a normal $4 premium, You might allocate $80 per ounce. But you arrive at the dealer and discover the real price is $87 or $90. Your planning was built on a reference price disconnected from actual supply conditions. Larger institutions with direct refinery contracts or vault relationships can bypass retail premiums. Smaller players cannot. The structure rewards scale. And here's the deeper issue. Position limits are supposed to prevent any single participant from dominating a market. Yet market makers and certain authorized participants often have exemptions. The entities capable of moving markets are frequently the ones with the broadest leeway. When 17,000 contracts hit in minutes and 14,000 transfer to strong hands rather than closing out, it raises legitimate structural questions. Not about secret cabals, but about incentives and architecture. Financial media typically focuses on charts and volatility. Price up, price down. Analysts debate resistance levels. But rarely do they ask whether the price being discussed represents the cost of acquiring the physical commodity at all. In February 2026, you could not find a single ounce of physical silver at $76. That simple fact speaks louder than any commentary. If a price cannot be realized in the real world, what exactly is it measuring? The answer is that it measures the clearing price of paper obligations between institutions. It measures the balance of leveraged bets. It measures liquidity and order flow. It does not necessarily measure the cost of sourcing refined metal, minting coins, shipping inventory, and meeting delivery demand. When the gap widens to 18%, you are not looking at minor inefficiency. You are looking at two distinct markets operating under different logics. None of this guarantees a particular future price. It doesn't mean silver must rally tomorrow or collapse next week. What it does mean is that modern commodity markets are layered. There is a derivatives layer, enormous in volume, dominated by institutions and algorithms. And there is a physical layer, constrained by mining output, refining capacity, and logistical realities. Most of the time, they move together closely enough that we treat them as one. During stress, they separate. February 2026 was one of those stress points. 85 million ounces sold on paper in 4 minutes. A $6 decline in 36 hours. $500 million in mark-to-market losses. And yet dealers raising premiums, extending delivery times, and refusing to part with metal at the futures price. If you tried to buy at 76, you couldn't. That impossibility is not a footnote. It is the entire story. Markets, as textbooks describe them, assume efficient arbitrage and rational actors. Real markets are ecosystems shaped by incentives, exemptions, leverage, and human behavior amplified by code. When derivatives grow far larger than underlying supply, the tail can wag the dog. Prices can be set by flows that never touch the commodity itself. And then, occasionally, reality reasserts itself through premiums, shortages, and delivery delays. In February 2026, the physical layer disagreed loudly, by $9 to $14 per ounce. And that gap is more than a silver story. It's a reminder that in a world saturated with paper claims and electronic promises, the difference between owning exposure and owning the thing itself can become very real, very fast.